Hey there students, in today's video we're going to be talking about T accounts. I'm going to show you how to learn these the easy way with 7 examples. Let's get into it. So, T accounts, what are they? Well, as you can see here, this is a great little visual of what a T account looks like. Now, you can see on the left side there's going to be debits, credits, have the account name up top. Looks like a T. You have the opening balance, closing balance. Now, if you don't know what this means yet, don't worry. Let's go and take a look at some definitions here. This is going to help you understand more exactly how this works. What is an account? That's the first thing we need to talk about. It's really just a place to record, sort, and store all transactions related to a group of items, any account. Okay, so first let's talk about some types of accounts you might see. An account would be like cash. Very common account, maybe accounts payable, AP, maybe insurance expense, or just prepaid insurance, if you want to call it that, right? Prepaid insurance. You might have supplies or accounts receivable, right? There's so many different types of accounts in accounting, and that's just where you store all these types of transactions, where they go. Now, debits and credits, if you haven't seen that video yet, right here you should see a little card you can watch my debits and credits for beginners videos, which I think will be very helpful if you don't know debits and credits. But it's just the process of increasing or decreasing balances in accounts based on transactions. So whatever type of account it is, if you debit it, it'll increase it, credit it, it'll decrease it. And just to remember it, use a little acronym called DEAD, D-E-A-D. You always debit expenses, assets, dividends. So when accounts increase, you always debit those. So all other types of accounts you will credit. That's a good way to remember that. But again, watch my video for a more in-depth explanation of debits and credits. And then lastly, T accounts. It's just really a visual representation of an account. So when you go ahead and map out transactions, this will be a visual representation. And so the easiest way to really know that is going to be, let's go ahead and take a look here at an example. So I'm going to go ahead and take this up and I'll show you kind of an example we can use. So with cash, let's talk about cash here. So cash is a great example here of a really popular account, a common account that you're going to make transactions in. And so just for example, let's just say we made a sale in cash for $10,000. This is the T account here for cash. How it works is you're going to debit on the left side and credit on the right. So that's important here. So you're going to debit over here. So we'll put a little DR. This will help you remember it. DR on this side, credit on this side. So if you made a sale in cash, cash is going up. Wouldn't you agree? So we're going to do this. Before we talk about that, there's usually an opening balance in that account. It opens up the account. Sometimes we have a balance already. Let's just say we do. Let's say we have $3,000 here for this balance, okay? We start out with 3K. Then we made the sale on January 1st, and that is going to increase our cash by 10,000. So we're going to debit it. So what we'll do is we'll do a little mark here. We'll say on 1/1, we went ahead and had a $10,000 increase. I'll just say 10K. So it increases by 10K. Then on 1/5, we bought an item for our business for $3.5 thousand. So what we're going to do, move this down here, we bought it. So that means cash is going out. So we're going to have to credit that. So we'll say on 1/5, so the day, cash went out by $3,500. Now what we're doing at the very, very end, there's no more transactions in this example, small example. I just wanted to show you this here. So we'll have our closing balance right here. The very last number. So if we had 3,000 to start with, we add in the 10K from the sale, but then we subtract the 3,500. So what is that? Well, you just do the math. 13,000 minus 3,500, it's going to be $9,500. That's our final balance in this example for the cash account, $9,500. That's what's left. So that's a basic example of how a T account works, just using a brief example. Let's go through a bigger example now that involves an actual business. So we'll scroll down here. So right now, and I'm going to move this. Let's see here. Okay, so Hank's dog grooming business. He does dog grooming, he does dog walking. He's starting a business. And here's a lot of different transactions that took place during the month of July. What we're going to do is we're going to go through each transaction. I'm going to show you how it looks on a T account to really fully explain it. So on July 1st, he invested into his business. He purchased a truck for transportation, $38.5K, right? So that's what he invested in. So how does that look? Well, we go over here. We have a lot of different types of T accounts we're going to use. We got cash, notes payable, prepaid insurance, supplies, a few different ones. And so I might have to add one here. I'm going to add one for truck, and I'll move that over here just so we have some room. So right here, we'll move this down, and we'll call this truck. And so truck, if you recall, is a fixed asset. It's fixed for your business. And so right here, we bought a truck. If you see, we bought it for $38.5. So what we're going to do is we're going to go ahead, and there is no opening balance for this, and so that sometimes does happen. So we didn't have anything here, 0. What I'll do is actually I'll change the color of this to make it a little more, you guys can see it better. Let's see if that's better. 0, opening balance. Then we got a truck here. So we're just going to go ahead and increase the truck by 38.5K. So 38,500, right? That's the truck. And so that happened on July 1st. So we'll just say that what happened there. And again, I put it on the left side, right? Because that's where we debit it. And truck is an asset. And assets, when they go up, they're debited. When they go down, they're credited. So we have that there. That's pretty simple. What we're going to do now is I'm actually going to make one more copy here. And we're going to move this down. And what happened, if you think about it, it purchased a truck for transportation. You invested it in the business. So what's actually happening there is we're going to have an owner's equity account. And that's what's happening. We're actually increasing it here. And what we're going to do is just move this over. Undo. We're going to move this over. It's right here. Same with this on July 1st. Now we're crediting owner's equity for 38.5K. You invested the truck went up in your assets, and your equity also went up too, because that's what you're doing there. You're investing in your business, so your equity actually increases. And right here, we have an opening balance of 0. Now I can tell you right now that this is going to go ahead and be the final balance for the truck for this period. Nothing else that we need to do. So 38.5K is actually your closing balance as well. So that takes care of July 1st transaction. July 5th, we had another transaction. We took out a loan for 30K. We're starting a business, it's a new business. We've got to go ahead and open this up. So 30K is the loan we took out. Now, how does that affect T accounts? Let's take a look. If we took out a loan, we're getting some cash, and that's nice, right? So we're going to go over here over to cash, and in this example, we actually had, we're going to go ahead and put a $10,000 opening balance. We started out with that. Then if you look at, we have a loan we took out for 30K, and actually that's going to increase this balance here. So it's going to go up, and I'll put 30,000. Again, K stands for 30,000. I just do it because it's easier to write out. We took it out on the 5th. So we had a loan here on the 5th of July for $30,000. So our cash went up, which is great. But we took out a loan, so that's actually going to be our notes payable. We have to record that as a long-term liability. And we'll just have an opening balance here of 0. Now, if you remember, payables are liabilities, so they increase with a credit. So we took out a loan, so we're going to be having to pay that back later. So that's going to be a payable and we're going to put 30K here. That's what we owe right now as of this time on 7/5. So that's what we're going to owe later on. We took out the loan. We're recording the note payable here in our T account. Now on the 8th, we bought some supplies for $2,500. So if you scroll down, we have some supplies here, and we'll just say it was a zero balance. Now if you think about it, supplies is an asset, right? So when assets go up, we have to increase it, right, with a debit. We bought it for $2,500, so over here we have a transaction date 7/8/20, $500. We bought some supplies. It increased. Then on the 14th, we paid for insurance in advance. We call that prepaid insurance. You pay for it up front. So you're paying for it, but that's actually an asset. So what happens is we paid for it in advance for $5,100. What's going to happen is our cash is going to go down. So that's a credit to cash. So 5,100 goes down on the 14th. So right here, we'll put, I'll just put it right here, 5,100 on 7/14, that date. It's actually going to be decreasing. You don't have to put negative because it's already on the right side. We know it's going down, but I just do it to show it's easier. 5,100, okay, so it went down. We also have to record the insurance. So insurance is over here. Prepaid insurance, we'll say we had a balance of 0 to make that easy. Opening balance, and it was 5,100 we paid, and that's actually an asset. So prepaid insurance, you would increase it. It is an asset on that 7/14 day. So it's going to be debiting here. And just a reminder, yeah, debit on the left, credit on the right. So we're debiting over here. Then we set up rent for a small office. We paid $8K up front for a year. So what is that? Prepaid rent. So we'll just also call it a zero balance, and it's an asset. So we paid $8,000 up front, paid for it up front, and that was on 7/19. $8,000. Well, we paid for it, right? So that's going to affect our cash. So we have to go up to cash here and also record that -8. I'll call it -8K. Sorry, you can't really. I do my best with these whiteboards. Sometimes it's really hard to write. But yep, 8K basically, and that was on the 19th. So -8K. Now, on the 22nd of July, we recorded salaries. We hired an employee, and we're going to schedule their payout end of month. So we recorded it up front. So what we're doing there is we're actually going to be a salaries payable. We're going to show that we owe them $1,700 later. Now, what does that look like? We'll just make this 0 as well. Well, payable is a liability, so it's increased with a credit. So on the right side here, we're going to be doing that, and that was for $1,700. Oops, sorry about that, 1,700. And that was on the 22nd. So that just shows that we owe them money later. And there's one I did not write here. Let me go ahead and get that for us. And we'll turn this into salaries expense. We have to also record that. Let me erase this. So salaries expense, we're going to go ahead and record here that 1,700 as well. It's on this side, and that's on 7/22. $1,700 is an expense because we are recording the expense because the event occurred. We're like, okay, we have to pay these people later, so we got to expense it now and record it as a liability. Later, we'll pay them. What else do we have here? Okay, we used up $1,000 of supplies on 7/29, July 29th. So if we go over here, supplies, we used them up. We had 2,500, but we used up 1,000. So we got to show that as a credit because the supplies account is going down. So we have to say $1,000. We used it up. on, or recording it on that day. So that's, you can call it a negative if you want, but then on the right side it's credit, left side debit. And then lastly, we paid out that salary we owed, that $1,700. We finally paid it out. So what's going to happen is we're reversing it on here. We're going to put it on the debit side now, because what we're doing is we're paying it out to those people, the employee that we owed. And we're also going to record that, since we're paying it out, record it in cash. So minus $1,700. We paid that out for them. And that's going to be at the very end of the month. Paid it out. Now there we are. So that's a lot of different stuff here. And so that is how you take transactions and move them into T accounts to keep track of each balance in each account. Now what we do is we go through and calculate and figure out our closing balances. So let's take a look. We'll start with cash. We got 10K, then we added in 30K, so 40K, minus 5,100, minus 8K, minus 1,700. So it's a big calculation. Let's go ahead and let me get my calculator here. We can do this. Okay, it's much easier on my calculator. So we'll start with 10K plus 30K minus 5,100 minus 8,000 minus 1,700. All right. So final balance here. All right, final balance, 25,200. And we put that on the left side because it's a debit balance. That's how it goes. And debit's on the left, and that's what's up. But now sometimes you might have a lot of debits, but then more credits, and it end up being a negative balance. And if that's the case, you have to put it on the right side because it's a negative balance. But over here, it's debit. Notes payable. Well, we really only had a zero balance. Then we have to record the note payable that we owe later on. And honestly, it just kind of ends there. You just move that balance down. That's the closing balance for this month of July. Prepaid insurance. Well, we paid it out. And at this point, we're not going to record what we call adjusting entries. So we'll just move this down. And that's your final balance as well. Supplies, we bought 2,500 and used 1,000. So closing balance here would be 2,500 minus 1,000. Easy math. 1,500 is our balance there on the debit side. Salaries payable. Well, we had 1,700 we owed, and then we paid it. So guess what? It's a zero balance. And since it's naturally a credit, right? Since it's a liability, we put it on the right side as your final balance. Let's go down to salaries expense. Same thing. It's just a 1,700 expense. It was just moved on down. Prepaid rent. Same thing. We had rent. I'm not going to do adjusting entries, so we're just going to move this down as your closing balance for prepaid rent. And let's see. We have that. We did that. All right. And then I think finally we had the truck. And then owner's equity, we're not going to really take into account any type of sales we might have made, which I don't think we actually made any. So don't worry about that. We're just going to keep owner's equity as on a credit balance, 38.5K for that truck to make it simple. So that's about it. What we did here is we talked about how to learn T accounts the super easy way with 7 examples. Talked about what the account was, how a T account works, went through some definitions over here, talked about a little example, and then went through a huge practice problem about Hank's grooming business. Went through all the transactions, marked them down into T accounts, got the closing balances. And that is how you do T accounts. It's fairly simple. It's a lot of just transfer of information and making sure you know your debits and credits, what types of accounts they are, recording it, and getting your closing balances. So hopefully that was really helpful. Went through a lot there, so definitely rewind it if you need to take notes. And thanks for watching. If you really enjoyed this video, please like and subscribe to the channel. It really helps support me and the videos I continue to create for you. And of course, if you have any suggestions, please comment below. Would love to hear from you. And lastly, my Accounting Student Accelerator is 85% off right now. It talks about going through a lot of different accounting lessons for both managerial and financial accounting, and it actually gives you real test questions to practice to prepare for your exams, and a bunch of other bonuses, PDFs, cheat sheets. Check it out. The link is in the description below. Once again, thanks for watching, and I'll see you in the next video.